To Afrinvest reporter, where we have the MD here, Mr. Ike Chioke, to take us through that report, looking at issues like Nigeria's external reserves, power assets, and interest rates on the table for this discussion. Thank you so much, Ike Chioke. It's a pleasure to have you.
Esther. Thank you for having me.
I went through the report. It highlighted a number of issues, basically the macroeconomic here in Nigeria. You talked about Nigeria's foreign exchange reserves, the Eurobond that some banks have taken, and the exposure of some banks to power assets. Let's start with the external reserves, around 39.4 billion as at August the 8th. But you also highlighted in the report that foreign portfolio investors constitute an estimated 38%. That's about 15 billion of that. How much of a risk is that to our FDI?
That can be a risk. That's an important factor to monitor, because as you see, the CBN has been trying to defend the Naira. And so the portion of the external reserves that's really available for defending Naira is not really as much as it will seem. On paper, you see almost $40 billion of external reserves. But when you factor in that FPI inflow in there is 40%, then that's actually not as much in terms of the cushion we have in the external reserves. Hence, we need to be I would say concerned, but that concern comes down to the issues that we've highlighted in the banking report itself, where you see there's been quite a jump in risk assets creation, particularly in the power sector, as well as in the oil and gas sector. For the power, what you saw in 2013 was a lot of banks supporting the bidders that bought the GENCOs and the DISCOs that were sold out of the former PACN. And this year already is about $5.7 billion of transactions recorded as a sale of the NIPP plants. And most of those are coming out of the balance sheet of banks, maybe 10–15% of equity contributions from the winning bidders. So that's quite a lot of risk asset creation. But if you look at the power industry itself, it's a Naira-denominated industry.
So you think that there's a cash flow imbalance?
There's going to always be... There's a currency mismatch, obviously. But the starting problem will be the cash flow mismatch, because those who bought the PSN assets are seeing that their cash flow projections are probably falling around 40–50% of what they had estimated because of issues in the regulatory side. And so what we're afraid of is if these are not resolved quick enough, then you're potentially going to start seeing non-performing loans crystallizing in banks' balance sheet.
But what do you think the banks can do? Or do you, I suppose, the banks, they must be doing something. If they see that coming, they must be doing something to mitigate against that.
Well, it's not just the problem of the banks. I think it's a wider problem, because, at the same time that the banks have created risk assets, they've all rushed out and done Eurobonds to kind of, rebalance their balance sheet again and make sure they have dollar liabilities against those dollar assets they've created. But if the underlying loans are not paying sufficient cash, and then you still have a currency mismatch in there, there could be a compounding effect where you could be seeing another banking crisis coming up.
But could things get better if the federal government can sort out tariff issues, gas supply issues?
Absolutely.
Because we know they're actually working on that.
And then that would then move us from potentially looking at a vicious cycle to a virtuous cycle, because if they can sort out those tariff issues, those power purchase agreement issues, and the regulatory ecosystem is working, then obviously there'll be more power coming into the economy, and obviously everybody will do better in Nigeria.
You talked about financial crisis, if all of that crystallizes in the system, and I saw something interesting in that report too, talking about the CBN's capacity of the central bank to undertake another bailout if that happens. Heaven forbid that should happen again. Yeah. Now, you say that over 40% of the CBN's asset portfolio is unmarketable and comprises mainly of AMCON bonds, among other things. You say that the CBN may be faced with just one option, and that will be to print money, and of course nobody wants that.
No, we don't want to do that. What we're highlighting is that obviously having done the banking industry rescue you saw in 2009, 2010 with AMCON, and eventually the AMCON bonds have all been moved on to the CBN balance sheet. You've got something like 5 trillion naira of AMCON bonds, DFI money, and all these intervention monies are sitting on the balance sheet. It gives the CBN less scope to be able to intervene again if there's a problem in the banking industry. And we're highlighting that from the report that certain risk assets that the industry has created are potentially looking problematic. But it requires all the parties who are involved to have a focus on this. It's not really a problem for the banks, it's also a macroeconomic issue, and you have to look at it from all the facets areas that can help to resolve it. But if there was a problem and CBN is now faced with a crisis, then we are suggesting that it's going to be more difficult for CBN to intervene this time than they did recently.
Because I know you also suggested that perhaps the CBN may be forced to raise the levy on banks, from the current 0.5%. Will that be enough? When this thing started, it had it at 0.3% of assets. Now it went to 0.5%, and there's another 0.33% of off-balance sheet assets. So it's already creeping up. As at 2013, the number in terms of the clawback of income from the balance sheets, from the profits of all the banks, is probably approaching about $1 billion. That's quite a significant sum in an environment where banks are seeing revenue opportunities dropping off. COT and they have to get more creative.
Is being removed, and suddenly, so the little income you're making, you're taking more of that and putting it into the sinking fund to pay off the AMCON exposure. So that's making it much more challenging for banks, which is why we titled this year's report Navigating Growth in a Challenging Environment, because most of the areas where they could make money are being blocked. You've seen now, there's a minimum amount of interest you have to pay on savings accounts. And
for all the banks, even the tier ones, obviously this kind of scenario would affect some banks more than others, but which of them would do better, handling such a scenario? The tier 1 banks, I suppose.
Well, it's interesting. The tier 1 banks have a bigger share of the market, clearly. So together, the 6 tier 1 banks have about 65% of assets, 65% of deposits. But the tier 2 and the smaller banks, they do too have their own niche following. I do think there's still space for the banks to be more creative and to grow. We've all kind of underestimated the size of the Nigerian economy. You saw that with the rebasing of the economy, that the banking industry as a percentage of the economy is actually now quite smaller. So that underscores the opportunity for the banks to look at different ways. And I think what is important is that banks really need to come out of the old traditional methods of making money and think of more creative ways and how you leverage on technology to get more efficiency.
Many of them will claim that they are already doing that. We've seen higher lending to the economy compared to 2, 3, 4 years ago. I guess they're doing better in that regard.
Be careful about that. Most of that lending is actually quite concentrated in the oil and gas sector and the power sector. We're not seeing enough lending trickle down to the SMEs and to the mass commercial sectors of Nigeria. That's the honest truth.
All right. Thank you so much, Ike. We'll leave it there. Thank you so much for taking us through parts of that report.
Thank you, Esther.
Well, that was Ike Chioke, Managing Director of Afrinvest Securities, looking at a report on the Nigeria macroeconomic environment and, of course, how it's affecting the bank.